Hey, good afternoon, everyone. I'm just going to give it about another 30, 45 more seconds because a lot of traders are just coming in. So let me give them just a minute and then we're going to start. Okay, everyone, ready to go. Thanks so much for giving me your time this afternoon. This is Mark from Right Line Trading, and we're going to talk about our money flow trackers software, which I honestly believe is, at least as far as I can tell, one of the only profitable ways to trade the markets. Now, quickly, this mandatory disclaimer that all signals and trading opportunities provided both orally or electronically are for educational and demonstration purposes only. Right Line Trading takes no responsibility for any profits or losses that may be incurred. Participating in the markets is risky, and you should not trade what you're not prepared to lose. Everyone knows that you could potentially lose a lot of money. Hopefully you'll make a lot of money, but the risk is there. Carefully consider your financial position prior to trading, and you may want to do your own due diligence, consult a financial advisor. And Right Line Trading is not a registered financial advisor nor a licensed commodities trading advisor. Now, with that said, we all know, I mean, when I started Right Line Trading 10 years ago, I mean, the market was a lot different than it is today. And when I say markets, I don't actually mean the markets that we trade, but the way things are in terms of software. The internet was not absolutely inundated on Facebook, YouTube, Instagram, Pinterest, you name it, with a million people who are telling you that they've already made, $7.5 to $25 million, and now they're just gonna, they're gonna send the ladder of success back down because they feel bad for you, and they're gonna sell you their software for a few $1,000s. I mean, the marketing has become intense. in my spam email, I get between 150 and 200 email solicitations a day for webinars and software. And I want to kind of distinguish myself from all of these people. Now, as far as I know, none of them graduated from an Ivy League university. I went to the University of Pennsylvania for 8 years. I graduated Phi Beta Kappa, and that's a national honor society where you have to finish or graduate in the top 2% of your class. I graduated with a degree in applied mathematics. Afterwards, I became a full-time professor at Jefferson College in Philadelphia. It's on Walnut Street in Philadelphia. And I only lived a few blocks away. I used to walk to work. And I was a single dad with 2 kids at the time. And it was tough. While I was at Jeff, I published 15 peer-reviewed articles. I consider myself first and foremost to be a scientist, a teacher, and an academician. I've mentored more than 30,000 traders over the last 10 years, and I spoke in many, many countries. The last country I was at was in the Philippines, and I was there the end of March, going into the first week of April, and I spoke in Manila. And when I was coming back home, people were just starting to wear masks in the airport. And I literally beat this whole COVID thing in the Philippines by probably a week to 10 days. If I would have gone a week or two later, I would still be there. And I'll just tell you, it's a long flight. It takes 30 hours to get from South Florida, where I am, to Manila. It is one long flight. But it's a beautiful country. The people are really wonderful. There's just a lot of poverty there. Now, what we have to do is we have to look at day trading and swing trading as a science. And if we look at it as a science, we have to look at what's been accomplished over the course of the last 40 to 45 years. And when we compare it with other academic endeavors or areas of scientific endeavor, like engineering, like mathematics, like architecture, we really see that we have come nowhere. Essentially, everyone is really trading some permutation of the same stuff that traders were using 40 to 50 years ago. It's price action, it's price patterns. Everyone's always pulling back the curtain on some secret price pattern that's already made them millions and millions of dollars. And now, like I said, they're going to offer this price pattern to you, and it's always going to work. Fibonacci and other things as well. Let's look at, and if we look at the other areas of scientific endeavor, like medicine, like electronics, like architecture, like engineering, they've made such enormous strides. I mean, we can't even compare the way they looked 40 years ago to the way they are today in terms of treatment for illnesses, in terms of electronics and just, cell phones and 5G and digital streaming. I mean, it's just night and day. And that's because all of these other areas are looked upon as formal academic areas. Every university has departments and professors that specialize in these areas. And most importantly, they're all subject to rigorous mathematical testing. And to give you an example, I mean, take a medicine. There are companies coming out all the time with new medicines, but before they can be released and used, they have to be analyzed, very, very rigorously. If it works, they're embraced, and if they don't work, they're rejected, and they're universally rejected, or they're universally embraced by the whole academic community. In trading, we get none of that. There's nobody who's testing mathematically whether pure price action works or has the predictive power to make you successful off the right edge of the chart, who tests price patterns, looks at Fibonacci. So we are just basically mired. And 95 to 98% of day traders and swing traders today go broke, and 95 to 98% of day traders and swing traders went broke 45 years ago. We have come nowhere. Now, the reason at this point is because this whole area, which really is an academic area that's sort of been given a brush off, really unfortunately, is controlled by marketers. I mean, they tell you what you want to hear. They tell you it's easy. They tell you it'll take you 30 seconds a day, and then you'll make a fortune. And whatever they sell you is going to be what works. And it's really unfortunate that day trading and swing trading is not looked upon with the same academic rigor that all the other areas of science are. It's really unfortunate for us. Now, I want to talk a little bit about pure price action and Japanese candlestick formations. Now, they really do have some power, and I think it really behooves every trader to understand, some of the basic Japanese candlestick formations. But remember, these were created 400 years ago. And let's think about the environment that they were created in and what they were created for. So say you had 100 kilos of rice, and you had 100 buyers, and you had 100 sellers. And you wanted to determine at any given moment in time who was more powerful, the buyers or the sellers. That's why the Japanese created Japanese candlestick formations. They were rice traders, and they wanted to know who was in control of the market, whether the rice was going to be purchased or the rice was going to be sold. And that's why we have Japanese candlestick patterns, and we have what we now call pure price action. Now, think about what would happen. Now, back in those days, here's the underlying premise that they made, and that was that the power of each individual buyer was approximately equal and approximately equal to each individual seller. So what you had essentially were 100 buyers and 100 sellers with about equal power to to govern or influence the market. Think what would happen if 400 years ago somebody stepped up to the market with so much money that they were willing to take charge and command of that transaction and offer a price that was so much higher than anyone else that they took control and they ruled. And they're going to buy the rice, and the sentiment of all the other traders becomes irrelevant. The same is true on the sell side. If somebody comes who wants to unload that rice and they have so much money and simply don't really care that much about how much money they sell it for, they're going to dominate the market. And what they do makes all the other buyers and sellers irrelevant. The rice is going to be sold at the price that they command it to be sold. And that's what's going on in today's market. What we have is big Wall Street money, and it actually isn't just Wall Street money. It comes in from all over the world. There's big banks like HSBC and other banks like Deutsche Bank, banks I can't even come to mind. But these are big institutions that have enormous power and enormous money. You have mutual fund money, you have 401k money, you have hedge fund money. And when these big traders come in and step into the market and decide that a futures market or a Forex market or a small cap, mid cap, or large cap stock is going to go in the direction they want it to go, all the other buyers and sellers become irrelevant. And all the other things that we use to track market sentiment become irrelevant. And that's why day traders and swing traders today so often go broke. That's because off the right edge of the chart, market sentiment becomes irrelevant when big institutional traders bring their money to bear on the market. And the same is not only true of price action, but it's true of price patterns. Now, there are two problems with this price pattern. Now, you have sequential lower highs and and equal lows, and your anticipation is that the sellers are in control. I mean, sellers are creating lower highs, and your anticipation is a bearish breakout and a move to the downside. Now, this is really based on the sentiment of us as small retail traders. Now, some of these patterns are going to work, and some of them are going to fail. But they have been around for 45 years, and anyone trading a falling triangle is never going to become profitable. And it doesn't matter whether that falling triangle looks back a week or a month or 6 months or a year. Now, a falling triangle going back a year may have slightly more power, but think of where your stop has to be if the trade fails. It's going to be 5 miles down. So basically, you're going to be in nosebleed territory if the trade fails. And here's the other problem with this pattern. You can't differentiate or make an assessment by simply looking at the pattern alone as to risk. It may be that some falling triangles have higher risk and other falling triangles have lower risk. But the pattern itself gives you no insight. You just have to take on good faith, because somebody told you so, that a falling triangle is very likely to be followed through by a bearish continuation pattern. And you have to trade every one of them the same, which is why you're going to go broke. The same thing with a rise. And now, this is what happens when big money shoots price out of a falling triangle. I mean, a big bank comes in. They don't care about us as small retail traders. They don't care about what we think. They don't care about our sentiment and what we've created off to the left. If they want to buy this instrument, it's going up. And if we're not poised to follow right behind them, they're going to run us over. Same thing with a rising triangle. Sequential higher lows, equal highs. Anticipation is a breakout to the upside. It works sometimes, it fails often. And basically, this is really created off of retail trader sentiment, not big institutional money. And when institutional money steps in, they can take this rising triangle and just plow price as far and as fast to the downside as they choose. And that's what happens very frequently. Out of a rising triangle, price will make a move up and then just crash to the downside, because it's big institutional money that does it. And it could be, you know, and it's just really one of these big institutions pressing a button on a computer, which triggers an algorithm, and down goes that financial market. So you have to step away from all of this, or you are never going to make money. And 99% of all the stuff that's offered to you is all based on this. There's also, you know, trading breakouts and momentum stuff, which very commonly fails. Now, I did want to talk about the J-hook pattern, because there's a couple of individual companies, and they're just marketing companies, that talk about the J-hook or fish hook and how great it is, and how they've made, you know, tens of millions of dollars trading it, and how you will too if you come aboard. And basically, what is a J-hook or fish hook? What it is some financial instrument, and a good example we can use, say, is crude oil. Pre-COVID, it's trading at $40 a barrel. The virus spreads worldwide. Government or country after country shuts down. All their economies grind to a halt. There's a glut of crude oil. And I think crude oil, what did it fall to, like $9 or $10 a barrel? It came all the way down. And I think it came down to not just multi-month, but multi-year lows. Broke through support at multi-week, broke through support at multi-month, broke through support, and then finally based at multi-year support. Then you see that based on Japanese candlestick patterns, we start to get a move up in price and the bulls take over. The anticipation is what we're going to do is we're going to create a bull flag pattern. We're going to move up, consolidation, move up, consolidation, move up, consolidation until we reach the top of the fish hook. And that's where we exit the trade. Here's the problem, and it happens very commonly. What we get is called a bull trap. And in the reverse, we get a bear trap. But in this particular case, big institutional money steps aside, and they do this on purpose because they make an enormous amount of money in running your stops. I mean, nothing allows them to go home with a bigger smile on their face than when they take home your money. So they let the small retail guys come in, create this fish hook, create this bullish formation, and maybe it'll move up a little bit, maybe it'll move up a little bit more. But their intention is to drive the market down further and stop everyone out who's taken a long position on this trade. Now remember, if you're at multi-month or multi-year lows, again, your stop is so far down, it's gonna be a bloodbath. So trading these fish hook patterns and J hook patterns, again, you can't make an assessment of risk. You have to take them all as being equally valid. And all the big institutions are right there to run you over, creating that, in this case, a bull trap. Now, there's one more that I wanted to show you because I just found it really interesting. And I go to other people's webinars all the time because sometimes I learn some really good stuff. A lot of times I just learn a lot of junk, but it's nice to see what other people are offering. Now, this is a proprietary candlestick pattern, and it really is proprietary. Now, the guy who sells it, whose name I would never mention, has copyrighted it and patented it. So you can't sell this formation. And it is a topping pattern and a bottoming pattern. And he opens up his presentation by saying he's made $15 million trading it, and now he's going to offer it to you. And what he's looking at is bulls try to create an up candle, and they create this long upper shadow or wick. They fail. The bears succeed in closing the candle to the downside to create this hammer. Then you get strong bearish follow through. You're in one tick below the close of this candle. Right here, anticipation is a complete breakdown in price. Now again, you can't assess which are the more powerful formations and which are the more weaker. You have to assume that they're all equal in power and trade every single one of them. Now, if there's one thing I want you to take home from this, whether you come aboard or not, and obviously I hope you will, because I would really like to help you become a successful trader, is that you cannot call a top or a bottom. And if you try to do it, you're going to get taken to the woodshed, as I've heard said many times, because the tops and bottoms are called by big institutional money. And you and I both know that a given market or given stock or financial instrument can be overbought or oversold for days, for weeks, for months, and divergence or any mathematical formula. None exist that can call a top or a bottom because they're created by variables that we cannot ascertain. And if we cannot ascertain all of the independent variables associated with the top and the bottom, we can't call one. So don't ever try to call a top or a bottom, or ever trade a program that prompts you to. I don't care if it's off of a double top, a triple top, a quadruple top, you're going to get run over so often that you're never going to be profitable. Now, the only thing I asked the guy who gave this webinar was, what is the positive predictive value of the entry? i.e., what percentage of these formations work? That's all that matters to you and matters to me, is if I take this pattern as a given that it's going to make me money, what percentage of them are going to work? And he wouldn't tell me. He answered a lot of questions, and he wouldn't answer mine, even though I typed it like 5 times. He just ignored it. So I knew immediately that it was baloney. So, but what I did was I just looked in the market and looked for his pattern myself. And here it is. It's a bottoming pattern. Now, this is not quite as elegant a hanging man as we saw in the reverse in the hammer formation. But here we have a lower shadow where the bears try to turn the market. The bulls close it to the upside. It's kind of a little bit of it's definitely a hanging man, but not a perfect one. Then you get strong bullish follow through. You're in one tick above the close, and boom, you get really nice a bullish move, and then total collapse of the market. And that's going to happen to you very often. I found multiple signals like this that just blew up. And oftentimes, since you're calling a bottom, again, what are we looking at here? I mentioned it 5 minutes ago. I hope you didn't forget it. It's a bull trap. All the big money is allowing you to do is see some bullish sentiment by small retail traders having a little bit of follow through. You go storming in, and they come right back in and smash this financial instrument to the downside. That's why you can't trade a fish hook, a J hook, whatever the heck, whoever named it those, and you can't trade a bottoming or topping pattern, because big institutional money is salivating, waiting to run you over. Now, I want to talk about Fibonacci for a minute, because if you go away and you do nothing, obviously it's perfectly fine, but I want you to learn some stuff. I just don't want to sit here and talk about my software. And I want to talk a minute about Fibonacci. Now, Fibonacci is, using Fibonacci as a tool to trade probably goes back, since since caveman times. Fibonacci was around in like the year 1205, early 13th century, and he created Fibonacci transformations from which we get Fibonacci numbers. And Fibonacci numbers tell us about a lot of wonderful symmetry in nature. The number of ridges on a pine cone, the number of edges on a snowflake. And they're really, I mean, you can do some really cool stuff with Fibonacci. But if you try to trade it off the right edge of the chart, you're going to get beaten up so badly. Because here's where we come to magical thinking. Why would a 13th century mathematician who never saw price movement in any stock market, or any market for that matter, be able to predict using his extensions or retracements market sentiment? Why at the 61.8% retracement would there be a ton of sellers here who, when price rose to that level, tried to push it down? There's no reason for it. It's just magical to think that they're there. So it breaks this level. So now we have more magic. Buyers just stampede into this line, and it becomes an area of, quote, Fibonacci support. So when price comes back down to it, it's going to bounce. What is the mathematical premise that it's based on, that somehow buyers and sellers are going to respect this level? And believe me, it's not because it's anticipated by 1 million people who have the same 61.8% retracement level, because you can pick any swing high and any swing low on multiple different time frames, on multiple different instruments. It isn't that. It's just all magical thinking. These don't work. We looked at we did a year look back. on Fibonacci retracements and extensions, even confluences. And they break and hold totally at random. Yet they this continues to hold attraction to traders. And for the life of me, I don't understand why. Because it doesn't work, and there's no reason to assume it works, and there's no way that anyone can explain to you why it should work. And if they offer it to you, they're just going to assume you believe them because they tell you it works. But that's not enough, and that shouldn't be enough for you. Now, to add a little bit more to that, at least Elliott and Gann, to their credit, studied price movement in the market. And what they tried to do was come up with formulas that accurately predicted market sentiment based on what they perceived to be recurrent patterns. And I believe that what they came up with back in the day had some validity, because neither of those guys were dummies. They were smart, very smart, brilliant mathematicians. But in today's market, where institutional money rules, the five-wave pattern of Elliott and Gann's equations to calculate price direction no longer have any validity, as does divergence signals, which again are top and bottom calling signals. And we know that's not possible to do. So this is all stuff you got to eliminate. And remember, it will be sold to you forever. In the year 2500, there'll be people selling you Fibonacci. It's really sad, but that's just the way it is. Don't trade it. Now, if all this stuff doesn't work, and I'm telling you it doesn't, what does work? And you know what? It's simply reflected in the failure rate. I shouldn't really have to do any convincing. 99% of day traders and swing traders are trading some permutation of what I just talked about. Price action, price patterns, Fibonacci, Elliott wave, Gann theory, divergent signals. It's some, mix and match of all that stuff. And almost all of them go broke. So I shouldn't have to convince you that it doesn't work, because it just doesn't. And again, the reason it doesn't work, and the reason I made this slide, is this big hand coming down and grabbing that candlestick is big institutional money. And it doesn't have to come from the United States, although it oftentimes does. But all it has to be is big. So price patterns, price action, forget about them, because they're not going to make you money. And as far as I know, and I'm not going to say that I have all the answers, because I don't. The only profitable way that I know to trade is to track institutional money and to trade one tiny piece of a footprint right behind them. They create the trend, and they're going to stop anyone out who's in the counter trend direction. And we can't be that can't be us. Now, just to really recap quickly, maybe 40 or 50 years ago, the market was comprised of nothing but small retail traders. All these small little marbles here. And everyone had an equal say. And all the stuff that I just told you didn't work might have worked. It's probably before most of us were born, and I'm sure it's way before all of us had a mouse in our hand and a computer in front of our face, because this was before computers. And if you remember, the first computer was a Wang computer. I'm kind of going off on a tangent, but remember what happened to Wang when Microsoft came out and actually developed an operating system? Wang went from $200 a share to zero and went bankrupt. But in any event, these are all those small retail traders. That's just not present anymore. Right now we have this guy, and he is the institutional guy. He is big Wall Street money. He is big bank money. He is 401k. He is hedge fund money. And as time passes, his dominance in any market is only going to grow. And we as small retail traders, our ability to determine direction of price in any given market, if we even have any at all at this point, is even going to get smaller and smaller. I mean, we're going to become infinitesimal in terms of determining the direction in any financial market. Now, again, in my humble opinion, you need a system that calculates the direction of big money flow. And what big institutions do in the course of a day is they rotate their money from sector to sector. I mean, let's face it, these big institutions, no matter what they are, from big banks to JP Morgan to Goldman Sachs, that money comes from investors. And those investors want a return on their dollar. And they don't make any money by leaving it in cash. They only make money by having it at work somewhere. So based on their assessment of risk, determines what sector they're going to put it in, whether they're going to put it into precious metals, which they certainly didn't do today, whether they're going to put it into stocks, whether they're going to put it into bonds or treasury notes. They're going to rotate it from sector to sector after they make an assessment of risk. If risk is on, it's Dow, NASDAQ, Russell, and E-mini. I think one of the markets I forgot. When risk is off, they pull their money out of stocks and they go to all the other things I mentioned. And I did leave out, there are some currencies that they're going to rotate into too. So what we do is we track this rotation from sector to sector using our proprietary technology. So we not only know the direction that money is going, we know where it's heading. So we can anticipate what's going to happen and watch the markets evolve and move in the direction that big money is going to push them. And just as a really quick aside, I don't want to divert from the topic. Right now, I see nothing but, I'm very bullish on the market, and it has nothing to do with fundamentals. It simply has to do with the fact that every government in the Western world is printing money to beat the band. They're all doing quantitative easing. They're all buying their own bonds and notes. And we're just going to be, we are essentially awash in money. And these big banks that have almost all of it, and big institutions that have almost all of it, they have to put it to work because the interest rates are at zero. The Fed rate is zero. And if they keep their money in cash, the value of it is just going to erode. And that's why I'm so bullish on the market. It's a rocky ride, and we're going to have big down days. But overall, between now, I think, and the election, we're going to see nothing but price rise. And that has actually nothing to do with the software. It's just my take on the direction of the markets. Now, here's the money flow tracker. Now, I said here that if you stay to the end, but if you come aboard at any point, you're going to get this. Now, it's infinitely configurable in that, let's say you're looking for a trade and you don't want to have 25 or 30 charts up. You can have them folded really down to like a little pancake and pop them. And you can watch 25 stocks. You can watch a dozen futures markets. I mean, I have people in my trading room that trade soybeans, wheat, and corn, as well as bonds and notes, and all the standards like the E-mini, the Russell, NASDAQ, and Dow, gold, and crude. You can trade. You can even track the NASDAQ 100 if you want, but you can do it on any time frame you like: a 2-minute, a 5-minute, a 15-minute, a 1 hour, a 2 hour, a daily. This is configurable any way you like. You can also configure it in tick, 377 tick, 450 tick, whatever tick chart you want. You can also configure it in Renko, Unirenko. It does not matter. And all you have to care about is the time frame of the chart you're trading, or the tick size of the chart you're trading. So on a 5-minute of Apple, you have a buy. That tells you that institutional money is aligned to the upside in Apple. And if you open up the Apple chart, you're going to likely get a software entry that's going to trigger you right into Apple. These are where all the low risk, high reward trades sit on the 5-minute chart. And here's where they sit on the 15-minute and the 1 hour and the 4 hour. So what time frames you configure really depends upon your style. You want to hold for 3 or 4 or 5 days, or hold for 2 or 3 weeks. That'll determine the time frames you put up here. And maybe you want to do both. Now, I wanted to show you a trade evolve real quickly, and I'm going to go right to the end. But I just want you to see that this background color has meaning. We don't display anything on the chart that doesn't help us create a risk assessment. That's what software is meant to do. Software was meant to tell you what is the likelihood that your entry is going to be a winner. That's all that you care about. What is the predictive value of the entry when, based on our trade methodology, you get an entry signal? So let's move it all the way to here. So the background color is meaning. The candle halo has meaning. These 3 colors have meaning. This oscillator has meaning. And they're all telling you something about the market. And we're going to quickly go through all that in a second. Now, the trade's going to execute. Now, this pivot has a lot of value. I mean, who's sitting in this pivot? Sellers. They turn the market down. And when you break a pivot, and I'm going to tell you how you really break a pivot, not how most software does it, because it does it incorrectly based on Japanese candlestick dogma. You're going to stop all these sellers out as this trade starts to move up. Now, once it catches that breeze, that backdraft of institutional money, it's going to fly.
Target fill.
Now, how much money you made on that trade is absolutely irrelevant, actually. I mean, it's crude oil. It could have been any financial instrument. It's on a Unirenko chart, which is what I personally like to trade on futures. I like time on Forex, and I like time on stocks. On futures, I like Unirenko. But when I say the amount money made on the trade is irrelevant, because it all depends upon the size of your portfolio. I mean, if you're trading a $100,000 portfolio, you could trade 10 contracts and you'd make $2,500. If you have a small, you're going to trade maybe 1 contract. So maybe you're going to make $150 or $160. The amount of money you make is not important. What's important is what is the likelihood that an entry here on this pivot break is going to work. And I'm telling you, it's at minimum, it's 75%. If you really mind your P's and Q's, and I'm gonna tell you the 2 critical things you need later on to day trade and swing trade successfully, you can push that to 85%. Now, here are the 3 key metrics that determine money flow. And what I'm going to do is I'm going to teach you a style of creating indicator analysis that you're probably not familiar with. And I wish I could claim credit for inventing it, but I did not. Now, quickly, what I want to tell you is this. No data obtained for indicator analysis off your trading chart will ever have future predictive value in determining where price is going to move off the right edge. So if you're looking at a MACD crossover on your trading chart, it's ridiculous to think that crossover on your trading chart is going to get you profitable. People have been trading MACD crossovers, oscillator crossovers, oscillator divergence forever, and they all go broke. The fact is, if data is used that comes off your trading chart, it will never have any future predictive value. You can't trade an indicator at all that uses data from your trading chart. Now, I would love to be proven wrong, but so far I have never seen one that can. Now let's quickly look. This is the most elegant, and it takes just a little bit of time to describe. The others are much simpler. Now this is just the volume ladder, and it doesn't matter whether this is a price level, and this could be a pip, a tick, or a cent, depending whether it's a stock, a future, or a Forex market. And this is the market delta value. And it tells you whether there's an overabundance of buyers or sellers on the dome. Doesn't talk about executed trades. It simply talks about the number of buyers or sellers sitting on your trading dome. So right here, we know that there are 812 more buyers than there are sellers. So you would think that buying pressure would push this candle to the upside. Inside here are stacked buyers and stacked sellers. Man, this was, I got this from another software program. They sold this very expensively, and the company that sold it is now vanished, and the guy who proffered it is now vanished because it just doesn't work. Here's also a positive market delta, but here's a positive market delta on a down candle. So why did that happen? And the reason is that the delta value doesn't describe the aggressiveness of the buyers or sellers. And remember, we're just talking about small retail traders, and small retail traders also have power. Now, on a positive delta, the reason this candle closed to the downside is because, let's say it's a stock trading at 50 bucks, and let's forget the bid-ask spread for a minute because it's really not important to the point I'm trying to make. The buyers, which are in excess, are only willing to buy it for $50 and a penny. But the sellers who own the stock and are sure it's going down are willing to sell it for $49.99, $98, $97, maybe even $96. They're super aggressive sellers. So the fact that there are more buyers is simply overdriven by the fact that the sellers are more aggressive. So any market delta value off your trading chart can really mislead you and walk you into a loser. Now, if you do an analysis going back 6 months or a year, you'll find that less than one standard deviation's worth of market delta values close in the wrong direction. And what we call these mathematically are outliers. You know, when you look at that bell-shaped curve, that's the data that's in those tips off to the edge of the curve. And what we've got to do is get rid of them so that the majority of the market delta values, which are correct and are powerful, can take control without these influencing the trade. So what we do is, it's really simple. What we do is, it's called a triple screen method of indicator analysis. Now, I first read about it in 1997, and it was invented by a guy named Alexander Elder. You can still get his book on Amazon. It's called Trading for a Living by Alexander Elder. It just went into its like 25 millionth printing. And I would challenge you to find another book on trading that was written 25 years ago that is just being republished again. That's how relevant and fresh it is 25 years later. Now, he made millions of dollars in an era when indicator analysis was very primitive. And this guy was a real bona fide genius and guru. So what he did was, he completely ignored any data off the trading chart and used indicator analysis based on the two higher multiple charts. Those are what predict the direction that your trading chart's going to take. And when we talk about higher multiple, if you're trading a 2-minute, we multiply that by 3, we get a 6. We multiply the 6 by 3, we get an 18. So we look at the 6-minute and the 18-minute. And why do we multiply it by 3? Because that's what he did. In his book, if you read Trading for a Living, he used on a time-based chart a multiple of 3. Let's say you're trading a range and you're trading a 5 range. He used the 2 higher multiple fibs. And fib does have symmetry. So you're trading a 5 range, you look at an 8 and a 13 range. You're trading a 377 tick, you look at the 610 tick and the next higher fib number. Bottom line, though, is your analysis completely ignores any data off your trading chart. Now we have to do one additional task, and that is throw out the outliers. So we take the market delta values on the 2 higher multiple charts, not necessarily time frame, and we put them into a 15-period simple moving average. So what governs our assessment of who's in control is based on the slope of the SMA, which is determined by the average of the last 15 market delta values. So that occasional market delta value, that's an outlier, is smoothed over by the fact that we use 15 of them in a row to determine who's in control of the market. And when both of those SMAs are sloping up, we as small retail traders can never create that kind of alignment. That means our order flow line is going to be green and big money is at work. When both 15-period SMAs are sloping down, the bears are in control. And we have to trade short because our order flow line is going to be red. And when we, the small, actually right now inconsequential retail trader, are in control, these lines are going to be, the order flow line is going to be yellow because these 2 SMAs are going to be sloping in opposite directions. So remember one thing, and this is another take-home message, which really, really is important. Your goal as a day trader and swing trader is not to get winners. That's your secondary goal. Your primary goal is to avoid losers. If you can sidestep losers, you can make an incredible amount of money on just a small number of winners. I mean, if you take a week of trading, I don't care what market you're in or how much money you're trading, and you take 11 trades and 10 of them are winners and 1 of them is a loser, you're going to make a ton. If 9 of them are winners and 2 of them are losers, you're still going to make a ton. If you can avoid the losers, you will be a professional, profitable trader. And that's the bottom line. Everyone who goes bankrupt trading the markets gets 1 trillion winners, but they also pull in 1 trillion losers. That's what we have to avoid. And that's called trading with specificity, not with sensitivity. We don't look to get every winner, we look to avoid every loser. And if we can do that successfully, we are there. Now here's those 2 SMAs heading down on the 2 higher multiple charts. And you gotta trade short. And if you look here, here's the order flow line. And you can see when you get an up pivot, the order flow line is going to lead price and let price fall into it. You're going to take the first up pivot. Now, my trade management may be different from yours, but I'm going to get knocked out on a down candle. Just going to go right back in on the up. I get knocked out, right back in on the up. Now, here's, I think, a key to what you need to see. See these 2 down candles? These are small retail traders who have decided the market has gone up enough. And based upon their assessment, we don't know what assessment they're using, and we don't care what assessment they're using. They're counter trend trading the direction of big money. You and I all know we can't call a top, but that's what they're doing. And they help propel the market to the upside. Same thing here. They try to create a down move. They're not going to do it as long as this line is green. And we're just going to run them over and let the market be propelled to the upside, not only by institutional money, but by running these short traders over. Now, remember, in the markets, you have an ally and you have an enemy. The ally that you must trade with is the big algorithmic initiators, the big banks, big Wall Street money, worldwide, the big institutional money. The enemy are the other small retail traders. You'll never take money home from the big institutional guys. They create the trend. So how can you beat them? When you go home at the end of every trading session with more money in your wallet, it comes from these guys. Counter trend trading, big money. And remember, in this move up, see these wicks? These are sellers trying to turn the market. Inside every candle is a wick. This whole move up runs over sellers in every single candle. These two counter trend traders just had enough power to turn the market briefly, which for us is great. It's going to knock me out of the trade, but I'm going to just run them over. Now, the second is Laguerre momentum. Now, momentum is a powerful force. And how does the market have momentum? Now, that's one thing that Alexander Elder tells you, and he makes it mandatory. If you read his book, and you should, because even though it's antiquated in some spots, it's really an awesome book. And what he tells you to do is never buy or a software package or do an indicator analysis. You haven't looked at the formula for the indicator. Now, if you look at an oscillator, what all oscillators are doing is simply comparing the distance between the low of the candle and the close of the candle. Well, as the close approaches the low, as the close gets tighter to the low, and tighter and tighter and tighter, you know that selling pressure is intensifying. And we call that downward momentum or price acceleration to the downside. I mean, big money is putting tremendous selling pressure on this market to press the close almost down to the low. That's what we want to see, and that's what's assessed by the Laguerre momentum. Doesn't measure speed, it measures price acceleration to the downside. Now, all the other oscillators, including RSI, which is sometimes used for other things, but if you look at the formula, it's just modified a bit, but it's just the same as all the others, as stochastic, as the Arun oscillator, as Williams R, as all of them. You'll see why, like, you know, these people will throw in a different oscillator or throw in different numbers in the oscillator and make you think they've developed something really cool. The bottom line is it's the same analysis. And if it comes off your trading chart, it's useless. Now remember, divergence is something we ignore. All the other oscillators were created to look for divergence and allow you to trade divergent signals. The Laguerre, which is the most recent addition to the oscillator armamentarium, was created only to track the direction of momentum. It'll almost never give you a divergent signal. It wasn't created for that purpose. If you look in the formula, it's huge. It's got a gamma and multiple smoothing factors. We've modified our Laguerre. It's unique, and it's just there to track momentum. So when both momentum lines on the two higher multiple charts are down or are up, I'm sorry, big money is accelerating price to the upside. When both momentum lines are sloping down, big money is accelerating price to the downside. And when both momentum lines aren't in agreement, there isn't any big money. It's you and I controlling the market, and we don't want to trade that. Because we're just going to fight with the other retail traders, and you know what we create? You know, ye old chop. You want to know where chop comes from? That's where it comes from. All the small retail traders who have equal power trying to determine a trend, and they can't. So now this is just the %K line. That's all it is. Heading up on the two higher multiple charts, and you have to trade long. And if you don't, price patterns, candlestick patterns, all that other stuff aside, you're going to get stopped out. You're very likely to get stopped out. Not 100%. That would be perfect, and we are not perfect. You will get losers, but they should be few and far between. Now let's combine them. So now, before you can take a short trade, you need the order flow analysis and the momentum analysis, both to be red, and order flow and momentum, both to be green. That's what creates or enhances the predictive value of a winner. Now, in order to avoid every loser, you're going to have to let some winners go because they're not going to align appropriately. But that's a mathematical axiom you can't avoid. So if you try to catch every winner, you're going to catch a ton of losers. If you don't care if a winner gets by you simply because it didn't conform to our rigid analysis and rules, and you don't care about it, like you don't have FOMO, you're going to trade really well. Now, the quant line is our neural net, and we all know that no financial instrument moves independently of all the other financial instruments. The fact is that every financial instrument in existence has some tie to every other one. And that's the basis for artificial intelligence and a neural net. And I believe that to be quite true. The problem, though, is that the association between some financial instruments is very vague and very weak. And they're so vague and weak. I shouldn't say vague. They're so weak that they really can't be harnessed to help us trade. It's just important that we know they exist, and we accept and embrace the underlying principle that no financial instrument moves totally independently of any of the others. That's just an important assumption to accept. Now, our quant line is here. Now, you already know from our really firm rules about not looking at anything that works on our trading chart that this is not looking. Now, I had to put the market in. I put the E-mini in. It didn't matter what I put in here. I could have put in a stock or a Forex. It's irrelevant. This is the quant line, and it's red. And when it's red, the E-mini is almost always going to fall. And when it's green, the E-mini is always going to rise. And what is it looking at to make the analysis so powerful? Well, it's not even looking at the E-mini. What it's doing is a triple screen assessment of the E-mini's correlative markets, our little mini neural net. And in order for us to get a red quant and take an E-mini short, we need the Dow, the Russell, and the NASDAQ to head down on that triple screen assessment. In order to go long, we have to get them all aligned to the upside on a triple screen assessment. That's what gives us the green, and that's what gives us the red. So not only is it not looking at anything that's going on the E-mini chart, it's not even looking at anything that's going on the E-mini. It's looking at the Dow, the Russell, and the NASDAQ. Now, if you trade against the multi-time frame alignment, I want to censor out the word time, the the triple screen assessment of these instruments, the likelihood of you getting stopped out is exceedingly high. And the reason we call them quant lines and not correlative market lines is because the correlation between the E-mini and the NASDAQ is very tight. So the NASDAQ is weighted quantitatively more. The association between the Russell is pretty weak. So it's quantitatively weighted less. And the Dow is in between. Now the correlation coefficient's got to be 0.7 or greater. If it's less than 0.7, it doesn't have really enough correlative power to help us trade. So now we're going to use all three. And if we don't have green, 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 and red, 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 we are going to stand aside. And we can easily define chop. And again, I wanted to use Unorenco because I don't want there to be anyone looking at price patterns or channels or anything along those lines. I'm just looking at the direction that institutional money is going to push the market. When you have green, 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 the market's going to rise. And when you have, I automated the slide in case I fell over and have a heart attack. I'm only kidding. But this is really the crux of the whole lecture. When the market's red, 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 and you know all the information and data that goes into creating these three red lines, multiple markets, multiple higher multiple charts, the price is almost always going to fall. And you can see all these traders in the counter trend direction. They're the retail traders, and they're the traders that are going to fatten our wallets every single day. They're going to counter trend trade against the direction of big money, and they are always going to fail. And there's tens of thousands of small retail traders, and there are probably thousands of new retail traders every week. Now, I also wanted to show that, that's an up move, and here you see you've got to trade short, that small retail traders can create small retracements. They have enough power to take the market up 3 or 4 candles. But we're simply going to let them do it, and we're going to take the first down pivot and run them all over. They simply help push our trade in the direction we want it to go. And so does big money. Remember, they love running the stops of retail traders. And down we go. Retail traders, down we go. A retail trader, and down we go. And so on and so forth. And then we go right back into chop. At a pivot, we never have a trade. Now, we do use what's called an exponential oscillator. It does only analyze price on our trading chart, but I'll show you why we can get away with it, because it's a signal that needs to be vetted. And every time the percent K line crosses this magenta line, you get an up blue triangle, down red triangle, up blue triangle, down red triangle, up blue triangle. Now you're going to get a lot of triangles that don't work. Here's an up blue triangle right across. This works because all 3 of our assessments are green. And there's our entry. Up. There's our red, red, red on the cross. And that works, and so we can go short. It's a signal that needs to be vetted before we can take it. Here's a trade, and I'm going to show you one of the absolute indications to exit the trade. Here's the oscillator entry. Now the candle halo, because I like you to focus on price rather than these lines, is order flow. We duplicated order flow. So you really don't have to look at this bottom line. A lot of traders just eliminate it. They make it transparent and they fold it up because it is projected on the candle halo. It is the most sensitive of the 3 assessments. Now, occasionally you're going to get a neutral, which is black. That doesn't mean anything. When the candle halo turns, which means that order flow has turned, you have to leave the trade. And you'll notice your exit is on an up candle. That's an absolute indication that's an exit by our rules. Here's the move down. These are neutral, neutral, candle halo, order flow, you're out. The other absolute signal to leave is an up oscillator signal in the counter trend direction that we're trading. Whichever comes first, we have to close up the trade. Now there's one other thing that we need to have, is we want everything in our favor. And let's say you want to trade Google long. You have order flow aligned long, you have momentum aligned long, Google's accelerating to the upside. You have the correlative markets of Google all aligned long. The only thing that you need long in addition to diminish the risk on the trade is Google aligned long in a triple screen assessment. You want your trading instrument to also have a triple screen assessment in the direction that you're trading. Now we assess that with background color. It takes no data off your trading chart. Only those two higher multiple charts. Now, light pink bisque and dark pink have differing power that I will explain in a master class. But dark pink are your low-hanging fruit. Light blue, cyan, and dark green. Dark green is the most powerful up alignment. Dark pink, the most powerful down alignment. So this is just looking at bias, and we call this background bias. When it's red, this dark red, the instrument may meander, and these could be minute bars, hour bars, daily bars, weekly bars. It doesn't matter. As long as this alignment is maintained, price is going to swashay around, but it's going to move to the downside. That's its trajectory. And as long as we have that I always want to say time frame, but as long as we have that triple screen assessment to the upside, you can see that cyan is intermediate in power, dark green is the most powerful, light blue is the weakest, but you can only trade long. Now, only trading with the dark green is really the best time to trade. But you can see that the trajectory of this instrument, just on the background alone, is very, very powerful. Now, after looking at this, and there's a mathematical formula that describes this, is that all independent variables are not equal. So that order flow does not have to equal momentum, does not have to equal the quant lines, but the most powerful of all is background bias. You need the instrument you're trading to be in a triple screen alignment in the direction you want to trade it. You're almost always going to have the support of those three metrics below you. But if they're all green, per se, and you don't have the kind of background you want, you can't trade. Now, finally, the last component is pivots. And then I'm going to show you trades. Now, a pivot, the way the Japanese candlestick guys wanted pivots to be created, is not the way 99.9% of software does it. Pivots come off of a candle body, not a wick. And the lazy, easy way to code a pivot, you don't really care if it works or not, is just take it at a pivot low. It's a lot tougher to take it at a candle body low. Now, what breaks a pivot, based upon the Japanese candlestick rules that are in Steve Nissen's books, if you read them, is you have to get 2/3 of a candle body to traverse it. Like if a wick crosses it, that pivot's intact. If 1/2 of the candle body crosses it, that pivot's intact. 2/3 of the candle body has to cross it to crack the pivot. And that's a really important analysis. And that's how our pivots work. See, this pivot here is broken by this last candlestick right here. Now, you might have thought it would have run, but look how far it's already come. But that's the pivot. That's the candle that breaks the pivot. Now, in addition, there is one indicator analysis sort of setup that did come and go. It's very rare in day trading and swing trading, But if you remember back like 3 years ago, or maybe 3.5 years ago, I mean, time goes so fast, I can't remember exactly. Remember, if you didn't trade market profile, you just weren't, you just weren't part of the in crowd. Everybody had to have market profile. You had to have a point of control. You had to have a value area high, value area low. You had to have all that stuff. And if you didn't, you just weren't with it. And everybody sold it. And I'm telling you, I knew immediately that it didn't work. I never bought into it. And we made one and analyzed it here in the office. And we proved to ourselves that it was all just a bunch of hooey. And if I had the time, I'd explain to you why. But we never traded it, we never bought it, and we never bought into its concepts. But there is one, and let me tell you, market profile costs more people more money, not just to buy it, but then to trade it and bust out of multiple accounts. It was like, I don't know, like quicksand. I mean, it's sort of depressing. But there was one thing about market profile that it had value, and it had high volume nodes. And high volume nodes is simply volume at price, where a ton of traders accumulated volume. And for some reason, these areas are, well, you know why, but because of a ton of traders crossed the market in this level, then they're still sitting there, and they create areas of strong support and resistance. But remember, if it's on your trading chart, it doesn't have the power to be predictive. And that's one of the reasons why market profile didn't work. So what we do is we look for high volume nodes that are confluent on the two higher multiple charts. And when they're congruent at the same price, we then project them onto our trading chart. And they are really rugged to break. And we never trade into them. And they're going to save you one ton of losers. Now, you have to make an assessment as to when they're going to break. And you see price crossed all the way down and it held, because this is a multi-chart assessment. So just because it traverses it on your trading chart doesn't mean it's snapped. But which we'll show you in that class, when to make a good assessment as to when this is going to break. So we just can't trade into them. Price approaches them and goes rejected and rejected and rejected. And this rejection sends it flying up. And to the upside is the same way. Up, rejected down, rejected down, rejected down. And I wasn't able to push off to the right edge. I don't know what happened there, but it looks to me like it's being rejected down. You want to avoid risk, like you'll get a rash or anaphylactic shock. So you stay away from support and resistance and don't trade into it. And I call a trade that doesn't have any support to the downside or resistance to the upside a free and clear trade. That's where you can go 30 or 40 ticks or $4 or $5 or 30 or 40 pips before you hit your first level of resistance or support. So just really briefly, and I'm going to get into this at another time, but you can always leverage an entry on a stock with an option. And I'm going to talk to you about this later on, just very briefly. You can buy an at-the-money call or an at-the-money put, but there may be even better ways to configure the trade. But I'm just going to sidestep this for now. It's just enough to know that it's around. So putting it together really is easier than you think, because the whole workspace is very intuitive. And if you're a newbie, you're better off than anyone else, because you don't have a lot of junk to unlearn, and you haven't been financially injured by buying a lot of software that's simply thrown you off the edge of the cliff. You're brand new, your trading account is sparkling clear, and you haven't walked that path. And I love working with newbies, but any of you can change your trajectory, believe me. Now, the entry is obviously exact. The exit is exact, and the targets are all pre-configured. Now here's an entry, all putting it together. There's your oscillator signal. Candle halo reflects order flow. And this is a 2-minute of Avago, and it's $10.12. You buy an at-the-money call, you make a ton of money. And remember, this is a 2-minute chart. This is not an IRA investment or a 401k investment that goes in, you're going to hold it for the next 36 months. You want to leverage this instrument with an option, and then you can make 100% easy on a $10 move. Here's Fiserv. I've laid off of it lately, but in general, I like to trade it. Here's your signal to the short side. Here's your absolute indication to leave on a changing candle halo. It's a $7.05 move on a 10-minute. That's a 9% move in the stock. Now, depending upon what you purchased, and as far as the at the money is concerned, you can make an awful lot on an option. And I didn't want to put up an options value because for just lots of reasons. Remember, if this trade was on a Friday, you're going to make more money. If it was on a Monday, you've got some time premium, and that's going to sort of mute the amount of money you're going to make. Plus, we don't know the intrinsic volatility of the instrument and a lot of other things. So I didn't want to put up, well, on this trade on this day, this made so much. I just want you to see that you can grab a big move with little risk on the trade, and how you leverage it, whether you buy the stock or whether you trade with an option, is going to be a lucrative endeavor. Now here's a 3-day hold of Google on a 30-minute for 51.66. There's the oscillator up, and there's the oscillator down, and there's your out. It's $51.66 over entry day 1, hold day 2, out day 3. Now, if you trade a 30-minute, even a 15-minute, you better be prepared potentially to hold overnight. You could close it at market close, but on Google, you would have missed the big move because it occurred on the 3rd day. Here's a $100 move on Amazon. There's the entry. There's the move up. There's no indication to leave as long as all 3 lines stay green and as long as the candle is haloed in blue. Oscillator cross and you're out. I mean, if you traded that with an at the money call, you got a lot of money. Now, obviously, the call is going to be very expensive, but I'm going to show you how to handle that later. Now, here's McEwen Mining, and I just put up McEwen. It's one of my favorite micro caps to trade. It's not a micro cap anymore. I recommended it at 40 cents. It's now trading at $1.40. Now, I don't know what it's trading today because gold and silver got ripped. But you can trade micro caps with a lot of risk because these are the only kind of stocks that are subject to small retail trader manipulation. And we all know it, so just be careful if you trade them. But you're going to get the same thing and the same multi-chart alignment. And we got 6 cents out of a 9-cent move. The bid-ask spread robbed us of the other 3 cents. It's an 8.5% move on a very cheap stock. Now the SPY and the Q, honestly, this really does well with. And when the SPY and the Q are choppy, you are going to stand down. It's going to keep you out of chop and get you in when the market trends. That pink background tells you that the SPY is aligned to the downside on our triple screen assessment. That's a big deal. And then we have all the metrics. First one is order flow. I'm sorry, the last one is order flow. The middle one is momentum, and the first one are correlative markets. And down we go, oscillator cross, absolute exit. Here's on a 30-minute, $26.44. Entry, whoops, and exit. Here's the cues, same thing. You will stay out of chop because you'll never get this pink background bias in a choppy market. You just won't get that triple screen alignment, nor will you ever get red, 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 and green, green, green. It's really honestly phenomenal in keeping you out of a trade in a very choppy market. And here's a quick 478 on a 2-minute. Now on crude oil, I like to trade Unirenko on futures. I like to trade time on stocks. And actually, I've moved over to time on Forex. But there's your entry. This is a 73 tick trade. There's your absolute exit. And you can see order flow changes the candle halo, and it's the harbinger of the end of the move. And on a long trade, you're out on an up candle. Here's gold. This is a trade I took. Now, this trade knocked me out because these retail traders created a down candle, and it also created a down oscillator signal because it just crossed that cyan line. So because it crossed it again, I went back in and ran them over. You just can't win when you try to counter trend trade against the direction of big money. So this was 44 ticks, and then whatever else I made here, here's your absolute signal to leave the trade. And you can see how the trade starts to collapse. Here's the E-mini on a 248 Unirenko, 10.5 points. There's your absolute indication to leave. And you can see order flow starts to fall apart. Line number 2, momentum starts to fall apart. Line number 3, correlative markets go yellow. So there's your harbinger. It infects line number 2, then it goes to infect line number 1. That's why we're out on this candle halo change. Now here's a 10, 20, 30 Unirenko. That's a huge candle, 24 pips and 66 pips. And the euro dollar, 32 pips. Now I have a bunch of testimonials on video, which to your relief, I'm sure I will not play. We have one from a man from the Miami Chamber of Commerce. We have one from a guy who's an elected politician here in Miami, who gave us a testimonial. And we have like 3 or 4 others. And Viviani's story is very heartwarming. She's only 24, 25. She's in college, and she makes really good money. And she's in the room every day with me. So I'll spare you the agony of having to listen to them, but they are really honest testimonials. And we have Miami Chamber of Commerce people and politicians who ain't going to give me a thumbs up if it isn't real. Now, in 2019, we made just over $120,000 trading options on stocks. We had eclipsed 130, and then we came back. Now, this is a short time frame. This is 2 months on crude. It's about 8 grand. And this is on the E-mini, and this is $15,000. This is 3 contracts on the E-mini, not 1 or 2. It's 3. And it was 2 contracts on crude. Now, this is just somebody who was sent in by one of our traders. His name is Hines. He sent it in on 7/7. He was so enthused. He had always been losing his whole trading career. He was making money every day, and he had his best day ever. He made $3,372 in 1 day on 7/7, and he sent me his NinjaTrader back end, and he just wanted me to see it. And so I'm not giving out anything more than his first name. I wanted you to see that this is what matters. It's not Excel spreadsheets and all this other junk that you see people put up. This is an honest to God back end of somebody else's trades. And you can see he basically took no losers. It's almost no losing money here. Now this I took just chat, went short on crude in the E-mini, nice E-mini winner. Wow, over $1,000 on one trade. I looked at ES is running. That's George, who's in the room all the time. That's all. Here's somebody complaining they can't get the bar close indicator to work. That's okay. We helped him out. But all I did was I pulled out his last name. I didn't think it was fair to project his last name. But he made over $1,000 on one trade. Now, I can't remember exactly what day this is, but obviously it was in the morning. Now, this has really become cliched at this point. Trading success equals financial freedom. You have no pressure. You have no boss. You wake up you wake up in your pajamas. You drag yourself to your computer. You turn it on. Trade for 13 seconds. Make your $27 million. Then you go back to bed. Well, it's just not like that. This is really sort of what my promise is to you. And my promise to you is that the software works. It really does predict the direction of price movement. It is not perfect. The predictive value of a trade is between 75% to 90%, depending upon the market, depending upon volume, which I didn't talk about, which we look at very closely, and two key things that you have to bring to the table, and they are patience and discipline. And that is why, as part of the deal, as you're going to see later on, is that you're going to trade for a month with me in the room, in my live trading room. Because if you don't have patience and discipline, nothing will make you profitable. And you need to have both. And by having me yakking it up and being in a trading room with 250 other traders, it's not such a solitary discipline. You don't get bored and you don't overtrade. And that's really the downfall of a lot of traders. They overtrade and they take risky trades. We don't do that. And so we'll work together. Now, again, like I said, I want to go through this quickly because I know your time is valuable. The workspace is really easy to use. It's very intuitive. Like I said, beginners are great to work with. And really, you can trade with any account size. You can trade the futures on the micros. We have a lot of traders in the room trading the micros. And they'll make $50 to $150 a day. And they're ecstatic. They can take home $500 a week. It's like, it's like gravy to them. And a lot of these traders are retired. They just want extra money. They're fixed income people. They don't want to risk a lot of money. And they trade the micros. And if they can make a few $100s a week, they're really, really happy. You can trade one lot on the Forex, and instead of trading the stock, you can trade the option. Now, here's the one thing I ask you to do. If we always do sell a limited number of copies to maintain the integrity of the entry, because we're all going to be entering at the same price, is that if you have an interest, and I'll tell you the cost later, and you're going to be surprised how inexpensive it is. If you have any interest and you put your name and phone number in the chat box, you will lock in that discount price. And I'm telling you, there are people that are going to get closed out of this deal. And Rory will call you. He's not our salesman. He's actually head of he actually does almost all of our education. I do a lot of it too. But he'll make one call to you, talk to you. If you have a question, you talk to him. If you don't come aboard, no problem. It's no big deal. So if you're out of country, please don't give us your phone number. We can call you on WhatsApp, but I ask you to give us your Skype, and we'll Skype you, because we get a lot of WhatsApp numbers, And we try to get you on WhatsApp, but it's a little tougher. So I would encourage you to do this. And it's no downside for you at all. Now, I want to make it very, very clear that the indicators only project on NinjaTrader 8. But like me, if you have Thinkorswim, which Sergio does a complete white glove installation, you don't have to worry, about tech. We worry about the tech, you worry about the trading. That's it. But he will take your data feed from Thinkorswim, drag it across. It was made for this purpose. And he will connect it to NinjaTrader 8, and it will run NinjaTrader 8. And you'll just take your trades on Thinkorswim. But you get a live NinjaTrader 8 platform for nothing, no money. We download a demo for you and resurrect it from the grave with the data feed from Thinkorswim. That same thing works with Interactive Brokers, eSignal, Awanda, and there are other platforms I can't think of. Now, your worst case scenario is you can't use it unless you actually open up a NinjaTrader account, and that'll cost you all of $100. And remember, that $100 is never used, but it gives you a live data feed. It gives you the ability to see the signals off the platform, and you take them on the platform that you trade, where actually your trading account is. It'll take you about 3 or 4 days to set up an account. It's very quick, and that $100 will just sit there, and you get a live data feed for whatever you want. So those are your options, but I just want to make it clear, you've got to see the indicators on NT8. So I don't want anyone to be misled. Now, I already went through this. This is part of the package. You're going to get this. We call it an analyzer. It's really more of a market scanner. It'll look at as many instruments as you want on any time frame. And if you look at too many, the only problem you're going to have is you're going to be overwhelmed by the number of signals you get. You're not going to know which way to turn. I mean, I used to trade the Forex at 2 o'clock in the morning, Eastern time. And I used to get 3, 4, 5 Forex pairs flash me buys at the same time because there'd be all the euro crosses. And then all the pound crosses would flash. Then all the dollar crosses would flash. So you're going to get lots of signals here. Now, it comes with a rapid results quick start guide. And I'm going to go through this quickly. If you're technically inclined, you can download it and start it up and running yourself. But like I said, if you're all thumbs technically like me, I built the software, but it's gotten so complex I can't even configure it anymore. Sergio has a master's degree in computer science, computer programming. He will do everything for you. Log onto your computer, set it up. If in the future it develops a bug, you just call us, we'll fix it for you. I mean, we're here all the time to help you. I mean, there's 5 of us here, and we're here. We don't live here, but we almost live here. I mean, it's unlike most other people where you can't get them on the phone. Now, I just want you to know that this is a purchase. It's not a lease. Like, you're not going to have to pay us in 12 months. 12 months from now, you're not going to look at your credit card statement and be shocked because you've been rebilled. You will never be billed again. When you buy it, you own it. And if we make it better and create a better entry or create a better indicator analysis, we give it to you for nothing. And I've had traders who came aboard 8 and 9 years ago that are still getting add-ons and upgrades. The platform doesn't even look like it did 9 years ago. But I honor my commitment, and you will always get the upgrade and add-on, and I will never charge you again. And remember, my training is in mathematical modeling, and mathematical modeling is never done. Like, we don't ever have a static workspace. We're always endeavoring to improve it. And I see workspaces out there that haven't changed in 10 years, and that is not going to help you. Now, the VIP support we give you, in a nutshell, is awesome, because we don't sell you software and then hide under a rock and take our phone off the hook. Like, there's a lot of companies, I listen to their webinars, I call them up afterwards. I don't have a buying question, I have a technical question. I get an answering service, I get voicemail, and I never get a call back because they don't care about me because I'm not asking to buy. If I called them up and said, I want to buy your software, somebody would pick up or I would get a call back immediately. We're always here, and I'm always here to support you. And my goal is to make you profitable and to get you to the point where you can regularly make money. Now, you're not going to make money every day. Nobody can do that. That's perfection, but almost every day. And we're here to do that for you. Now, we do coaching calls, and there's one coming in August. I haven't set the date yet. That's where we get about 400 people into the same room, all the people still connected to us who have the software, and we exchange trading ideas, talk about trade methodology, if there's any upgrades, add-ons, questions. The last one lasted 3 hours. It lasted forever. I mean, it lasted like the whole afternoon, and you're going to get that on a link. Now, your total investment is $997. That's it. You don't have to enter the promo code. Now, I gave you two really special add-ons. One is 1 year in the battle room. Now, we had a battle room today, which was supposed to, they're only supposed to go an hour, but they wind up going, this one went almost 2 hours. And what we do in the battle room is we learn the best way to trade options on a stock, on a day trading method, using a day trading methodology. We see an entry, we want to create the best trade configuration we can to leverage that trade to make the maximum amount of money on the minimum amount of risk. And you would be very surprised how difficult it is sometimes. Buying an at the money call is not always the answer. You never buy an out of the money, and you never buy an in the money. You're almost always going to buy an at the money, but that's what we do in the battle room. So if you just are not in shape, you haven't worked that day trading options muscle, that's what we do in the battle room. And today I went over a whole bunch of options trades that I'm sitting in, and a bunch of options trades that I recommended to our audience. And these are really good options trades. You also get a month in the live trading room where we're all going to trade together. I call the trades out way in advance, chart traders up, my stops and targets are projected. We go over every trade afterwards. And the trading room is not just to trade, it's also an educational experience. I mean, I usually spend about an hour after trading going over all the trades and just answering questions and just teaching. It can be a 3 to 4 hour session if you want to stay, but sometimes the trading we're done in 20 minutes, and then I spend an hour and a half teaching. Now, if you're making great money, maybe this can help you make more money, but you are in good shape. And if you learn something from this webinar, I mean, I'm glad, because I wanted to make this a lot more than just, start with here's my software. I could have made it a lot briefer, but I think it gave you more of a gestalt for what's necessary for trading, whether you come aboard or not. If you're having trouble trading, I mean, if you're trading water, if you're inconsistent, if you're using some of the stuff that I talked about today, I'm telling you, it's going to hurt you. And I don't mean that as a salesman or anything. I mean that from my heart. It's not going to work for you because it doesn't have any predictive power. So even if you don't come aboard, I suggest you get rid of it because it's not going to make you money. So here's the offer again: a year in the battle room, 1 month in the live trading room, on $997, and that's a lifetime ownership. You're going to get a receipt if you purchase it. Everything will be listed out in that receipt. It'll come to you electronically, and everything that I talked about that you get will be listed out on that electronic receipt, including the battle room and the live trading room. And again, I encourage you to put your name and phone number in. Let me answer any questions. Hey guys. Hang on one sec. I got to scroll to the top. Okay. Oh, geez. Hi, Dimitri. What institutional money flows into 5 minutes or 15 minutes? Doesn't it mean it also flows in our time? Shine, institutional money can come and go fairly quickly. I mean, if you look at moves on gold in the futures market, or crude in the futures market, or some of the Forex pairs, institutional money will make lightning strikes, and they can push up a financial instrument an enormous amount in a quick period of time. Remember, they're just in there to make money. They don't have to hold long term. And if they take gold and push it up 45 ticks, they're going to make a fortune, not only from the move up, but from running over everyone caught in the opposite direction. So remember, we're talking about a short-term trade, and this webinar is about day trading. If you want to talk about swing trading and long-term trading, then you're going to have a 15-minute candle, or you're going to have a 30-minute candle, and you have to wait for institutional money to align on these higher time frames. They're going to come less frequently, but the move you're going to get is going to be far greater. So really, the magnitude of the move and the size of the move is going to depend upon the time frame that you're looking at. Okay? Institutions do, Sean. I don't agree with that. Institutions do make, just take a look at gold one day, and you'll see 50 and 60 tick moves on gold. And believe me, you and I did not create those moves. I mean, when you think of the amount of money that it took to send crude or gold 60 ticks in one direction or the other, it's no way it's us. That is big money. Hey, Abe, how you doing? Your selected chart examples look good, but what are the stats on a daily basis for wins versus loss? How big are your stops? Well, those are all, just call Rory about that, Abe, seriously. Your stops are all pre-configured, and your stop is going to be a reversal candle, and that's based on market structure. So that's the size of your stop. So if you're trading a 5-minute candle, you're going to have to wait. Well, on a 5-minute candle, it can be a little bit different. But if you're trading Unirenko, a range, a reversal candle takes you out. It really depends upon the instrument and the time frame. I just want to, and like I said, the predictive value of an entry is going to be 75% or greater. There's no reason why you can't get 3 winners out of every 4 trades if you have patience and discipline. Now, there's other rules that I mean, I can't do our whole trading methodology in this webinar. They're not cumbersome, and they're easy to learn. But remember, you want to trade tight to the 50. There are a lot of other things that go into making a perfect trade. If you stick with those rules, you're going to wind up with a profitable afternoon. The thing I don't want you to think is that you're going to spend 8 minutes in front of a computer and walk away with a fortune. Hey, Noel, thank you for your name and number. Now, Noel, okay, you're in the United States. Thank you, Noel. Can we use this in the UK? Absolutely, you can use it in the UK. We have so many people in the United Kingdom, really. I don't know about TradingView, Mitz, but I just know you can. You may have to set up an account with Interactive Brokers. I'm not sure, but you can definitely use it in the UK. And we have people using it all over the world. I mean, South America, a lot of people in Singapore, Australia. I mean, Singapore seems to be very popular. I mean, we seem to be popular in Singapore. So it doesn't matter where you are in the world. Hey, Dimitri, where do you put your stops? For me, I put them on a reversal candle. If I'm trading time-based charts, like I do on Forex, I'm going to put them at the next level of support. Remember, we have the pivots and we have those volume zones. And you have to make a determination. That's going to determine where your stop's going to be. I mean, it's going to be your next area down where the trade should stop. Hey, Dale, thank you for your number. Appreciate it. Hey, Ray, you have an NT8 lease which doesn't have order flow. I guess I have to buy the lifetime license for the system for it, but no, you're not correct, Ray, because our indicator takes the raw data from NT8 and calculates order flow on its own. Like if you, in order to get order flow calculated for you from NT8, you need the lifetime. But if you let us calculate it for you, you can use the lease, and you do not have to go to a lifetime license. The order flow line is the one that is the most, uses up the most system resources. And our overall platform uses in the aggregate very little system resources. But because it does a very complex calculation of order flow on its own, you don't need Ninja Traders. We do it for you, Ray. Hey, thank you for the number. Do you have a payment plan, Roy? Just give Rory a call, okay? I leave those all up to him. Hey, Abney. The cost of the monthly live trading room, Abney, is $199 bucks. Now, after the first month, it's your decision as to whether or not you want to come aboard and stay. If you don't want to stay and you forget to cancel, and we bill you, you just call us and we give you your money back. I don't want you to stay in the room unless you really want to be there. But you have to decide whether collectively being in a room with a couple of hundred traders, with myself and the teaching and the support, is worth the $199. I can tell you that most traders stay, but it's totally your call. For 30 days, you don't have to worry about it. For $997, I would not, Abe, I wouldn't show anything you didn't get. What I showed you, you get everything I showed you. That would be very misleading and actually pretty underhanded if I projected indicators and you didn't get them for the $997. You get the full software package, everything I showed you. Does that price include the software and what happens after the year? You own the software for life, Wayne. The only thing that expires after the year is the battle room. And the battle room is where you learn how to trade options on stocks to day trade. The software is yours for life. And honestly, see after the 997, it doesn't say per year. It doesn't say lease. I mean, I should have typed in lifetime, but regulatory agencies get pissed, excuse me, I don't want to say pissed off. They get mad because lifetime presumes that you'll have it until the day you expire. And you know, it's ambiguous. Bottom line is, it's yours forever. And like I said, if we have an update or an upgrade or an add-on, you get them for nothing. And this is the way I've been running this company for almost a decade. And honestly, I could make a lot more money if I charged you for every upgrade and add-on and didn't even mention them in this webinar and threw out a 2.0 version, then a 3.0 version, and charged you $499 bucks for each upgrade and add-on. But I just don't think it's ethical. So we give you those for free. The only thing that you'd have to pay over again is that 1 month in the trading room. And that's because I put so much time and effort into that. That's a monthly recurring charge. And that's your only recurring charge. And you have a year to decide whether you want to come back and you want to stay in the battle room. So I wouldn't worry about that now. but that's your other recurring, but that's a year from now. So really the only one that's really operational is your month in the trading room. And again, you have a month. And if you forget and you get billed and you don't want to be in the room, you just call us and we'll give you the money back. I'm looking for 4 to 5 E-mini points. What size of Unorenko? We use a 2, 4, 8 Abe, and I'm telling you, we do really well on the E-mini. And I'm going to be 1,000% honest with you today, to everyone in the room. Today was one of the first days we lost money on the E-mini, I would say in a few weeks. Because what I do after we finish trading, I look at each individual instrument. How do we do on crude? How do we do on gold? How do we do, we didn't take any Russell trades. How do we do on the Dow? How did we do on the NASDAQ? Today on the NASDAQ, I didn't take any losers. I had 4 trades and 4 winners on the NASDAQ. It was one of the very rare days we didn't make money on the E-mini. Usually the E-minis are cash cow. And I am not kidding you. But I'll tell you today, we lost a couple $100 on the E-mini. Now in the aggregate, we made money. But I also break it down every day by instrument, right off of my NinjaTrader back end. I show you every trade with text and markers up, and we go over the performance of each instrument that we trade. I mean, the one thing that nobody will dispute is the transparency and clarity of what we do is incredible. You can't be more transparent than the way I run that room. Thank you for your Skype. Great to have you aboard, Abe. Really. I mean, if you want to give us a call, you can. I don't know where our phone number is. We'll also be sending you a link very shortly, but there's our phone number. But I think Rory's on the phone already, and we'll send you a link. I do trade on NinjaTrader. That is terrific. And if there is hope to become profitable, there's more than hope, Abe. All I need from you is discipline and patience. Take my trades and just stay with me. And you're going to start off on sim, get to learn the system, start slow, and then you'll have years to trade profitably. And I'll tell you, a lot of people say it's all layback and there's no stress. Well, let me tell you, when I take a trade, I stress to the max, even on the lowest risk trades. That's my personality. My heart rate goes up. You know, I always get nervous. I don't know any other way a human being can react, but you will make money. And you'll feel a lot more comfortable when you close up and say 8 out of 10 sessions or 9 out of 10 sessions, you've made money. But I've been doing this for 10 years, and I'm telling you, I still get nervous when I execute a trade, and I will do that for my entire life. So I always get a kick out of it when I see stress-free, no stress. It's stress because your money's on the line and you want the trade to go. And every trade you take, there is some risk, but we're going to work together. We're going to get there because most of the traders in the room are there. And I'll just say one last thing and then I'm done. Most traders in the trading room are better traders than me. They make more money than me. And I really am proud of that. I do my thing. They take most of my trades and they make more money. Everybody posts their profit at the end of the day. And there's no reason for them to lie. They don't have to post anything. And they wind up making a lot more than I do. Or they end earlier than I do. William, if you come aboard, I'll give you an hour of my time for nothing. I'm just a nice guy. I want to help you. And I'm not going to charge you. I hate that. I mean, Rory will schedule some time for you when I'm free. Okay, then you just call Rory and he'll give you an hour. And I can probably do it on Wednesday or Thursday. And you and I can sit together and we'll do a one-on-one together for an hour. I have no problem with it, William. Okay? And I've done it with many other traders, and there's no way I would charge you for it. I just don't like that. I want you to make money. All right, everyone, thank you so much for giving me your time. I really, really appreciate it. No matter what you decide, I wish you the best. Stay safe. I don't know how much, no, my pleasure, William. I don't know how much COVID is a risk. I guess it is a risk. Nobody here has it, but stay safe and let's make money in the markets. And let's take really, here's how I look at it. No, we will, Abby. Here's how I look at it. We're a small group of retail traders. Maybe there are 400 or 500 of us actively trading. Maybe there's 600, I don't know. But we're very supportive of each other, and it's our goal to beat up every other small retail trader out there. And that's what I want to do almost every day. Have a great, great afternoon, and I look forward to seeing you in the trading room. And everyone knows I do my utmost to make everyone money and to make you guys successful. Take care, everyone, and have a great, great afternoon.